Learning Module, Market Efficiency. Topic: Implications of the Efficient Market Hypothesis. In a semi-strong form efficient market, an analyst who carefully studies only publicly disclosed financial statements and earnings announcements is most likely to generate abnormal risk-adjusted returns that are significantly positive, B approximately 0, C significantly negative. In a market that exhibits semi-strong form efficiency, the most appropriate conclusion for an investment manager is that A. Active stock selection will consistently outperform a passive index strategy on a risk-adjusted basis. B. Passive index investing will generally outperform most active management strategies on an after-cost basis. C. Active managers can still earn abnormal returns by focusing exclusively on private information. Assuming a market is semi-strong form efficient, the net of fees risk-adjusted performance of a typical active equity manager, compared to a low-cost passive market index, is most likely A. Higher, B. The same, C. Lower. An investor who relies primarily on chart patterns, moving averages, and historical trading volume to make buy and sell decisions is most likely assuming that the market is A. Semi-strong form efficient, B. Weak form inefficient, C. Strong form efficient. An equity research analyst who regularly identifies undervalued stocks by analyzing financial ratios, earnings quality, and industry trends from public financial statements is most likely assuming that the market is A. Semi-strong form efficient, B. Strong form efficient, C. Semi-strong form inefficient. If a market is strong form inefficient but semi-strong form efficient, the type of active management most likely to consistently generate abnormal returns is A. Technical analysis using historical price trends, B. Fundamental analysis using public financial reports, C. Insider trading using private company data. A pension fund's investment committee is deciding on a management strategy. If they believe the equity market is semi-strong form efficient, their most appropriate course of action is to focus on hiring managers who specialize in high-frequency technical trading, B. Selecting active managers with proven records of earnings-based stock picking, C. Implementing a strategic asset allocation and minimizing management fees. A regulatory change that mandates more frequent and detailed financial reporting by publicly traded companies would most likely lead to A. A higher number of arbitrage opportunities as data becomes more complex, B. An increase in market efficiency due to greater information availability, C. A decrease in trading activity as investors are overwhelmed with data. Semi-strong efficiency means all publicly available information, financial statements, earnings announcements, analyst reports, macroeconomic news, is already incorporated into prices. So fundamental analysis based only on public data cannot generate abnormal risk-adjusted returns. The expected outcome is approximately 0 abnormal returns. Positive abnormal returns, option A, are ruled out because public information is already reflected, and negative abnormal returns, option C, are not implied unless the analyst's methods are flawed. Efficiency implies 0 abnormal returns, not losses. Semi-strong efficiency means all publicly available information is already incorporated into prices, so active strategies based on public data cannot consistently generate abnormal returns. Because active management adds costs, passive index investing generally outperforms after expenses. A. Active outperformance is ruled out since public information is already reflected. And C. Private information belongs to strong form efficiency, not semi-strong. Semi-strong efficiency means all publicly available information is already incorporated into prices, so active strategies relying on public data cannot consistently generate abnormal returns. Because active management carries higher costs, its net of fees performance will be lower than passive index investing. A. Higher returns is ruled out since public information cannot be exploited for consistent outperformance. And B. Same returns is incorrect because even if gross returns were equal, active management's higher fees reduce net performance. Technical analysis relies on past price and volume data. So for it to work, markets must be weak form inefficient. In a weak form efficient market, those patterns are already incorporated into prices, making technical analysis ineffective. Semi-strong efficiency, option A, deals with public information beyond past data, which technical analysis does not use. And strong form efficiency, option C, includes private information, which technical analysis also does not exploit. Fundamental analysis relies on public information such as financial statements and industry trends. So for it to generate abnormal returns, the market must be semi-strong form inefficient. In a semi-strong form efficient market, public information is already fully reflected in prices, making such analysis ineffective. A. Semi-strong efficiency rules out abnormal returns from public information. And B. Strong form efficiency concerns private information, which fundamental analysis does not use. Semi-strong efficiency means public information is already reflected in prices, so both technical analysis, historical data, and fundamental analysis, public reports, cannot generate abnormal returns. But if the market is strong form inefficient, private information is not fully priced in, so insider trading can consistently earn abnormal returns. A. Technical analysis fails because weak form efficiency is implied, and B. Fundamental analysis fails because semi-strong efficiency rules out public information. Semi-strong efficiency means all publicly available information is already incorporated into prices, so neither technical analysis nor fundamental analysis can consistently generate abnormal returns. Because active management adds costs, the most appropriate strategy is passive management, with diversified asset allocation and minimized fees. A. Technical trading is ruled out since weak form efficiency already eliminates profits from past price data, and B. Fundamental analysis is ruled out because semi-strong efficiency ensures public information is priced in. More frequent and detailed financial reporting increases transparency and reduces information asymmetry, which strengthens market efficiency because prices adjust more quickly and accurately to fundamental values. A. Arbitrage opportunities is ruled out since greater disclosure reduces mispricing. And C. Decrease in trading activity is ruled out because transparency typically encourages more participation and supports efficiency. Topic: Market pricing anomalies, time series and cross-sectional. Which of the following anomalies is most accurately classified as a cross-sectional anomaly? Momentum effect. B. Book-to-market value effect. C. Earnings announcement drift. A researcher discovers that a trading rule based on the direction of the previous month's return generates statistically significant positive, risk-adjusted returns over a 30-year historical sample. This finding most likely represents a conclusive proof of market inefficiency, B. A market anomaly, C. A profitable strategy for future implementation. Empirical studies show that small capitalization stocks have historically delivered higher risk-adjusted returns than large capitalization stocks. An investor seeking to exploit the size effect should most likely focus on stocks with below-average trading volume. B. Market capitalization. C. Dividend payout ratio. Historical data reveals that stocks with low price-to-book ratios have generated superior risk-adjusted performance compared to those with high price-to-book ratios. To take advantage of this value effect, an investor should most likely select stocks with below average A. Earnings growth rates, B. Price to book ratios, C. Dividend growth rates. A quantitative analyst develops a strategy that involves buying stocks that have been top performers over the past 12 months and selling short stocks that have been the worst performers. This strategy is most directly attempting to exploit the A. Value effect, B. Size effect, C. Momentum anomaly. The persistent observation that stocks with high dividend yields have outperformed those with low dividend yields, after adjusting for risk, represents a value anomaly that least likely challenges which form of market efficiency. A. Weak form, B. Semi-strong form, C. Strong form. Cross-sectional anomalies are identified by comparing different stocks at a single point in time based on firm characteristics, such as the book-to-market ratio. The book-to-market effect is the classic example of a cross-sectional anomaly. A. Momentum is a time series anomaly because it relies on a stock's own past returns over time. And C. Earnings announcement drift is classified under other anomalies since it is studied around specific events, not cross-sectional firm characteristics. A trading rule based on past returns producing abnormal results over a long sample fits the definition of a market anomaly, since it suggests patterns inconsistent with the efficient market hypothesis but not conclusive proof of inefficiency. Conclusive proof is ruled out because anomalies may stem from data mining, frictions, or biases rather than true inefficiency. And C. Profitable future strategy is ruled out since anomalies often disappear once exploited or eroded by transaction costs. The size effect is a cross-sectional anomaly based on company size, measured directly by market capitalization. Small-cap stocks, below average market cap, have historically delivered higher risk-adjusted returns than large-cap stocks. A. Trading volume and C. Dividend payout ratio are unrelated to the size effect. The anomaly is specifically tied to market capitalization, not liquidity or dividend policy. The value effect is a cross-sectional anomaly, where stocks with low price-to-book ratios, value stocks, have historically outperformed those with high ratios, growth stocks. To exploit this, investors must select stocks with below-average price-to-book ratios. A. Earnings growth rates are linked to growth stocks, which underperform value stocks, and C. Dividend growth rates are not the defining metric for value stocks. The critical measure is the price-to-book ratio. The described strategy, buying recent winners and shorting recent losers, directly exploits the momentum anomaly, which is the tendency of past top performers to continue performing well and past underperformers to keep lagging. A. Value effect is ruled out because it relies on fundamental valuation ratios, not past returns, and B. Size effect is ruled out because it depends on market capitalization, not performance history. Weak form efficiency only covers past price and volume data, not public fundamental information like dividend yields. Since the dividend yield anomaly is based on public ratios, it does not contradict weak form efficiency at all. B. Semi-strong efficiency is challenged because it requires all public information, including dividend yields, to be fully reflected in prices, and C. Strong form is also challenged since it includes public information as well. Dividend yield anomalies are fundamental or public information anomalies, so they contradict semi-strong and strong forms, but are fully consistent with weak form efficiency. Topic: Behavioral finance. A proponent of behavioral finance points to the frequent occurrence of investor herding and overreaction to news headlines as evidence that market participants are often irrational. A defender of the efficient market hypothesis would most likely counter this argument by stating that the hypothesis requires A. That arbitrageurs are consistently able to identify and profit from the irrationality of other investors. B. Only that the market's collective pricing outcome is rational. Not that every participant is rational. C. That all investors base their decisions on a rational analysis of all available information. An investor feels profound regret and anxiety from a $5,000 loss in a stock, but experiences only mild satisfaction from a $5,000 gain in another. This behavior, which can lead to holding losers too long and selling winners too early, is most directly explained by the behavioral bias of A. Mental accounting. B. Loss aversion. C. Overconfidence. Excessive stock price declines following negative earnings surprises are most likely explained by investors exhibiting A. Overconfidence in their ability to forecast recoveries. B. Loss aversion that amplifies the impact of bad news. C. Anchoring to previous price highs. An investor sells a stock that has doubled in value to lock in the profit, but continues holding a stock that has lost half its value hoping for a rebound. This pattern is best explained by A. Anchoring bias. B. Confirmation bias. C. The disposition effect. A behavioral audit of 3 equity analysts at a hedge fund during a volatile 6-month period identified these tendencies. Analyst J held on to underperforming securities longer than average while quickly exiting outperforming ones. Analyst K updated earnings forecasts more gradually than peers in response to surprise corporate news. Analyst L felt greater distress from a 2% portfolio decline than satisfaction from a similar gain. Which analyst most likely demonstrated the disposition effect? A. Analyst L. B. Analyst K. C. Analyst J. An investor has held shares of a technology company for many years. The company recently releases a series of disappointing earnings reports and a warning about future growth. Despite this new negative information, the investor holds onto the stock, stating, "It's always been a great company, and I'm sure it will bounce back." This investor is most likely exhibiting which behavioral bias? A. Representativeness, as the investor is classifying the new information based on a familiar pattern. B. Confirmation bias, as the investor is seeking out information that supports their existing belief. C. Conservatism, as the investor is being slow to update their prior positive view in the face of new negative information. Which of the following is least likely to be cited as a behavioral finance explanation for the momentum anomaly? Stocks that have performed well continue to outperform. Investor overconfidence leading to underreaction to new information. B. Disposition effect causing investors to sell winners too early. C. Herding behavior among institutional investors. EMH requires prices to fully reflect available information. Not that every investor is rational. Irrational behavior can exist, but as long as collective pricing outcomes remain efficient, EMH holds. A. Arbitrageurs consistently profiting is not required. And C. All investors rational is not assumed. EMH only demands that the market as a whole incorporates information efficiently. Loss aversion explains the stronger emotional pain from losses, compared to the weaker satisfaction from equivalent gains, which leads to behaviors like holding losers too long and selling winners too early. A. Mental accounting is about categorizing money into separate buckets, not emotional asymmetry. And C. Overconfidence is about overestimating one's predictive ability, not the unequal emotional response to gains and losses. Loss aversion explains why investors react more strongly to losses than to gains, which can lead to panic selling and excessive price declines after negative earnings surprises. A. Overconfidence is linked to underreaction and momentum, not overreaction. and C. Anchoring causes slow adjustment to past price levels, underreaction, the opposite of the excessive decline described. The described behavior, selling winners too early and holding losers too long, is the classic definition of the disposition effect, which stems from loss aversion and leads to suboptimal investment decisions. A. Anchoring only explains fixation on purchase price, not the asymmetric treatment of gains and losses. And B. Confirmation bias is about selective information processing, not realization timing. The disposition effect is defined by the trading pattern of selling winners too quickly and holding losers too long. Analyst J's behavior matches this exactly, making him the one who demonstrated the disposition effect. A. Loss aversion describes the emotional pain of losses versus gains, but not the trading pattern itself. And B. Conservatism or anchoring explains slow updating of forecasts, not gain or loss realization behavior. The investor's behavior, clinging to a long-held positive view despite clear negative new information, is the definition of conservatism bias, which is slow updating of beliefs when faced with new evidence. A. Representativeness would involve stereotyping or pattern matching, which is not shown here. And B. Confirmation bias requires actively seeking supportive evidence, which is also not described. The disposition effect, selling winners too early, holding losers too long, actually works against momentum, since it reduces upward pressure on winners rather than reinforcing their continued outperformance. A. Overconfidence or underreaction and C. Hurting are both behavioral explanations that can support momentum, while B. Disposition effect is inconsistent with it.